Hello everyone. Today we'll discuss the topic capital structure and evaluation. So we'll start with the introduction, the meaning for capital structure. So capital structure of a company refers to the composition of its capitalization and it includes all long-term capital sources, namely loans, reserves, shares and bonds. The capital structure of business can be measured by ratio of various kinds of permanent loan and equity capital to total capital. So capital structure refers to the combination of mix of debt and equity which a company uses to finance its long-term operations. A healthy capital structure that reflects a low level of debt and a large amount of equity is a positive sign of investment quality. So capital structure is always focusing for the long-term purpose, not for the short-term, mainly for the equity and the debentures. So here we have the differentiation about the capitalization and what is capital structure and financial structure. So capitalization means it's a combination of the equity share capital, preference share capital, debentures and term loans. Then capital structure, equity share capital, preference share capital, debentures, term loans and also retained earnings. Then the difference for financial structure, it's combination of equity share capital, preference share capital, debenture, term loans and current liabilities. So capital structure focus only for the long-term purpose. It includes retained earnings. Financial structure, it is the combination of both long-term as well as short-term liabilities. And we have different type of theories, so capital structure theories, net income approach and net operating income approach, then traditional approach, Modigliani-Miller approach with and without tax, then pecking order theory. These are the different type of theories and factors affecting the capital structures. So there are internal and external factors which will affect the decision-making process for the capital structure of the organizations. So the managers, they will focus different type of factors internally and externally, which is influencing to take the decision for the capital structure of organizations. So the internal factors are the financial leverage, risk, growth and stability, then retain control and cost of capital, cash flow, flexibility, purpose of finance, asset structures. And external factors are size of the company, nature of the industry, investors, cost of flotation, legal requirements, period of finance, level of interest rate, level of business activity, availability of fund, taxation policy, level of stock prices. So both the categories, the managers or the directors of the company, they will decide how they're going to allocate the fund for the long-term purpose and what are the factors they need to consider while taking the decisions. Then what is optimal capital structure? The optimal or the best capital structure implies the most economical and safe ratio between various types of securities. So it is the mix of debt and equity which maximizes the value of the company and minimizes the cost of capital. So these are the essentials of a sound or optimal capital structures. One is minimum cost of capital, then minimum risk and maximum return. Maximum control should be there and safety for the investment, then simplicity, and also it should have a flexibility, then focusing on the legal requirements. So capitalization refers the total amount of long-term funds employed by the firm, and cost of capital is the rate of return that a company must earn on its investment to satisfy its investors. So both debt and equity holders. It's essentially the minimum return a company needs to make on its projects to maintain its current stock price. So the difference between the financial structure and capital structure. So financial structure is different from capital structure. It means the composition of the entire liability side of the balance sheet. It shows the way in which the firm assets are financed. So financial structure includes long-term as well as short-term sources of finance. Already we have discussed initially. The capital structure signifies the proportion of long-term sources of finance in the capitalization of the firm. It is represented by shareholders fund and long-term loan. So capital structure is a part of the financial structure. Now these are the theories we said, and from that we will discuss the first theory, net income theory or Durant theory. So this theory was proponed by David Durant in the year 1959. It is known as fixed theory or cost of equity theory. So according to this theory, a firm can increase the value of the firm and reduce the overall cost of capital by increasing the proportion of debt in its capital structure to the maximum possible extent. It is due to the fact that debt is generally a cheaper source of the funds because interest rates are lower than the dividend rate due to element of risk. So the benefit of tax as the interest is deductible expense for income tax purpose. So these are the characteristics of the net income approach. So capital structure matters in determining the value of firm. It suggests the value of firm increases by decreasing the weighted average cost of capital, and weighted average cost of capital could be reduced with a higher debt to proportion in financing. So always the cost of raising fund through debt is lower as compared to equity capital. So cost of debt is lesser than the cost of equity capital. So lower cost of raising fund through debt results in decrease in overall cost of capital. Thus, the value of firm is maximized. So these are the few assumptions for this theory. So there are only two sources of financing. One is debt and equity. There are no corporate taxes in this theory. The cost of debt is less than the cost of equity, and the proportion of the debt does not affect the risk perception of the investors, and dividend payout ratio is 1 or 100%, and here no retained earnings. So the next theory we will discuss in the next video. Thank you.